What's up, Facebook? Ty Crandall here with Credit Suite, and today we're talking about business credit scoring. So last week we talked about consumer credit scores. We talked about what you need to do to have the best consumer credit scores. We talked about FICO, we talked about Vantage scores, we talked a lot about how the consumer credit scoring system worked. We talked about credit scorecards. There's a lot of stuff we talked about relating to consumer credit scores. This week, today, we dive into business credit scores. We talk about commercial credit scores. We talk about those credit scores that your business EIN has that determines if you'll get a business loan, if you'll get a credit card, the rates, the terms you'll pay, how much you'll pay on the credit cards and the business loans that you get. All of that is based on the quality of your business credit score. So today we're going to decode these. I'm going to talk through your Experian and Equifax commercial scores. We're going to talk through your Dun Bradstreet credit scores. What you may not know is that on your business credit reports, you could easily have about 5 credit scores that show up on each of these reports. So we're going to decode these. Most importantly, we're going to talk about legal hacks or things that you can do to improve or quickly obtain good business credit scores so you can start to get high limit revolving credit cards in your business name linked to your EIN, not your social. Wayne, welcome. Thank you so much. Ferris, Tooley, thank you for sharing. That's awesome. Good morning, Michael. Thank you very much for coming in. So today it's all about decoding business credit scores. Guys, I love decoding stuff, and here's why. If you know how your business credit scores work and you know hacks or things you can do to legally have the best score, well then you can easily have the best business credit scores, get the most amount of credit that you want to get the best loans that you want to get. It's all based on your business credit quality. So let's decode how these business credit scores work, teach you how you can get the best business credit scores so you can get the highest limit, best credit cards, highest limit, best loans, and credit lines for your business at the best terms. So Carla, welcome. Thanks for coming. So today we are going to be talking more about the second type of credit. So let me grab my marker here. So last week we talked about consumer FICO. We talked about consumer scores. We talked about FICO score and how it works and how your auto industry score is different than your mortgage score. And we talked about Vantage score, the credit bureau's own score. And we just decoded this whole thing. Next week, we're going to talk about your bank credit score, the secret score that your bank won't tell you even exists that's used to determine if you'll ever get a business bank loan. Today, we're going to be talking about your business credit scores, how these things work, and most importantly, how you can get good scores so you can start getting high limit revolving credit card accounts, credit lines, and loans. So let's start right here at the top with the D&B PAYDEX score. So the D&B PAYDEX score is the most popular credit score in the commercial world. It's the most popular, well-known business credit score. You probably hear a lot of people that say, I have a PAYDEX of X. Well, the PAYDEX is Dun Bradstreet's top credit score. Now, Dun Bradstreet is the biggest of the business credit reporting agencies. So a lot of people think that business credit's new, or this is a new concept to them. But the reality is business credit's been around a lot longer than consumer credit. Dun Bradstreet, the biggest business credit reporting agency, was around 70 years before the first consumer reporting agency. So not only is Dun Bradstreet the biggest reporting agency in the world, they have like 230 million records on file, but they're the most well-established credit reporting agency that ever existed. I mean, how well established? Literally five United States presidents have worked for them somewhere throughout their history. So a really big, a really creditable outfit, and their main score is called the PAYDEX score. Now, the way the PAYDEX score works with Dun & Bradstreet is it's really got 2 factors you should know about. The first is your payment history, and the most important. The second is called weighted average, which I'll tell you about in a minute as well. Here's how PAYDEX works, and here's why it's so easy to get good business credit scores at high limit accounts without a personal guarantee or personal credit check. Because Dun & Bradstreet's PAYDEX score is basically based on how you pay your bills. It's that simple. If you pay your bills on time or promptly, you get an 80 score. If you were to pay your bills on average 14 days late, you'd have a 70 score. If you pay it early within the discount period, 90, and 100 scores payment early. The bottom line is, to have a good business credit score with Dun & Bradstreet, all you have to do is get 3 accounts that report to them, pay them on time or early, and you'll get a good score. Now, most lenders and credit issuers will look at a 70 and a higher as a good score, 14 days late or on time or early as a good score. Now, D&B does have another factor they refer to as weighted average. And what weighted average is weighted average says that the highest limit account you have will weigh more into your overall credit score than a lower limit account. So for example, let's say you have a $10,000 limit credit account and a $5,000 limit credit account. Well, with weighted average, if you had to go late on one of those, you'd want to go late on the lower limit account, the $5,000 limit account, because that would cause less damage to your credit score than the higher limit account. So with Dun Bradstreet's credit score, there's two things you need to know. Most importantly, pay your bills on time or early. The minute you get an invoice for a trade vendor revolving source that reports to the business reporting agencies, pay that invoice. The sooner you pay the invoice, the higher your score will be. It's that simple. Guys, this is why business credit scoring is so awesome. Let me show you. Because with business credit scores, you can come in with no credit established, get some accounts at places like Uline, Quill, Gimplers, etc. Ricardo, Paul, welcome. And Ferris Tooley, again, 7 others. Thank you guys for sharing. So you get, let's say, 3 of these accounts. Let's choose 3. Uline, Quill, Gimplers, Granger. I chose 4. You get these accounts, you use them, you pay the bill. They report to Dun Bradstreet, Equifax, and Experian. When 3 accounts report to Dun Bradstreet says, well, how did you pay those accounts? If you paid those accounts on time or early, they give you an 80, 90, 100 score. Now you have a report, you have trade lines, you have a good score. Then when you start to walk into places like Apple, Chevron, when you walk into Amazon, when you go to BP, almost any major retailer, and you start to apply for credit, you can leave your EIN or your social security number off the application. That forces them to not pull your consumer credit report. It forces them to pull your business report. Your business report has 3 trades with Dun Bradstreet. You paid the accounts as agreed or early. That gave you a really good score. Okay, so now you have an 80, 90, or 100. To give you a comparison, maybe that's like having an excellent FICO score of 750 or higher. So by paying your bills on time, you have the equivalent of, like, on the consumer world, what you're familiar with, an excellent FICO score quickly, like within 30 to 90 days. So now you have an excellent score and trade lines, and now you go in to apply for Apple. For a commercial credit card, you leave your social security number off the application, they pull that business credit report, and they start approving you for really high limit accounts, right? 10 grand, 15, 20. These are all real approvals that people that follow us on our live streams tell us as they're getting approved, and then we pull their credit reports to verify. So 11,000 Visa and Bank of America's and $30,000 Amazon and 40 at Dell and 40 at Best Buy. All this is possible because they're pulling your business credit scores, not your consumer credit scores. So it's easy with Dun & Bradstreet. This is why business credit's awesome. It's so fast to get good scores because all you have to do is get accounts that report to D&B and pay them as agreed. And again, if you're ever going to go late, then you pay the lower limit account late versus the higher limit account. It'll do less damage to the scores. Were you able to confirm if Macy's still set up business credit accounts? Yes, we did research and Macy's still is issuing business credit accounts. You just need to speak with somebody in their commercial division, Michael, just so you know that. So let's look at the second most popular, or one of the most popular, probably the third most popular business credit score that exists. It's called the Equifax Credit Risk Score. Now, this is a commercial score from Equifax that works very similar to Dun & Bradstreet's. It's all based on how you pay your bills. So if you pay your bills on time or as agreed, you get a 90 plus score. Michael, thank you very much for sharing this. I really appreciate the shares and the likes, guys. It means a lot. If you are 1 to 30 days late, 80 to 89, and so on and so on. The bottom line in with Equifax and with Dun & Bradstreet is the scores are based on how you pay your bills. So if you pay your bills as agreed, you get a good score. Very different than FICO, right? FICO is a disaster. FICO is a disaster because if you look at your consumer FICO score, really look at this. If you try to improve one area of the score, you damage another. Here, I'll show you. Let's say you try to get a mortgage because you need a better credit mix. The minute you apply, you put an inquiry on your credit report and you hurt this part of your score. Then you've got a loan that's equal to the amount that you borrowed, so you hurt your utilization. So when you try to fix one area, you damage another. Let's say you need more positive payments, so you apply for new accounts. Well, then that puts new inquiries on your credit report. You damage this aspect of the score. FICO takes many years of well-disciplined borrowing because when you try to fix one area of the score, you damage another. Now let's look at business credit scores. What do you have to do to get good scores? One thing. Get accounts, pay them as agreed, you get a good score. So it's very easy and fast to build Equifax and Dun Bradstreet credit scores that are then used to get you high limit revolving accounts. Now Equifax, unlike DNB, only needs one account reporting for them to actually rate that account and give you a score. But here's the bigger problem. The bigger problem is Experian and Equifax will give you a score even if you have 0 accounts reporting. They don't need any accounts to report to give you a score. As a matter of fact, I see this all the time. People have a 27, 28, or 29 score with Experian. Guys, that's really bad. That's a really low score. Here, let me give you a comparison. The FICO score goes up to 100, right? If you had a 27 or 28, it's the equivalent of failing. I mean, that's an F. If you were comparing it to your FICO, that's as bad as you can get. Well, you're going to get a 27 or a 28 score with Experian and Equifax, which is right here, just because they know you exist and even if you have no trade lines. So how do they know you exist? They're reporting agencies. Their whole job is to gather data and sell data. And a large place they get is from the Secretary of State. So when you file your first annual report with your company, they get that information. And if they know you exist, they populate a profile, they give you a score, a really bad failing score, even if you have no trade lines that are bad. So the problem is this will keep you from getting credit cards and loans at your bank because they'll pull a bad business credit score and they'll deny you for that reason. But here's the catch. They don't have to tell you that. In the consumer world, if you get denied because your credit's bad, they have to notify you by writing in mail of what bureau they pulled and why they made the decision. Well, there's no Fair Credit Reporting Act in the business world. They can deny you and will deny you all day long and never have to tell you why. So if you go in to get a credit card at your bank and they pull your business credit report, which I promise you they will do if you're applying for a business credit card, they're not going to tell you they do it, but then they see a 27 score, a failing score because you have no history. They deny the credit card. You may never know why, and it's because your business credit scores are horrible because you don't have any credit established. So beware. Equifax and Experian will absolutely 100% give you a profile and score if no accounts are reporting good or bad. And if they do that and you have no positive accounts, your scores will be horrible. Here's the great news. It only takes one account with Equifax and Experian for them to give you a positive score. So all you need is one account that reports to them that you pay as agreed or early, and you'll change that 27 or 28 score like that up to an 80, 90, 100, and all of a sudden you go from getting denied for everything to now being able to get approved. Guys, it's the beauty of business credit. It's really simple to get good scores if you get accounts that report to the business CRAs and pay them as agreed. That's what you got to do. But if you don't do that, don't think you can hide. They're going to know you exist and give you a low score just because you didn't do it, even with no bad credit. That's why it's so important to build your business credit. Is 3 trade lines considered 3 vendors? And is 3 reporting on DNB and 2 on Experian considered as 5? Well, that's a good question. In the business credit world, we refer to these as payment experiences. So an account that reports to a reporting agency is called a payment experience. So if an account reports to DNB and Experian, that would actually be 2 payment experiences. Now, for DNB, you've got to have 3 payment experiences. That's 3 individual accounts that report just to DNB. And when those 3 accounts report to DNB, that's 3 payment experiences, and that's what's needed to give you that score. So let's look at the second most popular credit score that's out there. Very different than the Equifax and Dun Bradstreet score we've talked about so far. It's called the Experian IntelliScore. Now, in the business credit world, this is how it works. A lot of people look at PAYDEX, especially for leases, landlords, etc. Banks really look at Equifax. They like this. Credit issuers look at Experian. So if you want credit cards, you really need to focus on Experian. If you want bank loans, you really need to focus on Equifax. So here's how Experian's IntelliScore works. 50 to 60% of the overall score is based on payments and balances. 10 to 15% utilization. 10 to 15 is derogatory items. 5 to 10 is historical behavior. 5 to 10% is age, industry, and size. Kind of similar to FICO, right? FICO has these 5 different aspects, and each accounts for a percentage of the overall score. Same as IntelliScore. But if you really look at IntelliScore, let's really look at this. Payments, how you pay your bills, 60%. Derogatory items, how you pay your bills, 15%. Historical behavior, how you pay your bills, 10%. So even though it's made up of a lot of factors, if we do the math here, 60, 75, 85, up to 85% of the entire score is still based on how you pay your bills. Yes, a little percentage has to do with utilization. Yes, an even smaller percentage has to do with the size of your business, basically, and the risk of your business. But if you pay your bills as agreed with Experian, you're also going to get a good score. Now, it's more important with them that you focus on your utilization, but what's most important is that you pay your bills as agreed, and you'll get a good score with Experian as well, even though these other factors tie into your score, such as age, industry, and size. So those are the three main scores. D&B, completely based on how you pay your bills. Equifax, completely based on how you pay your bills. Experian, mostly based on how you pay your bills. Some other items, such as the size, age, and industry that you're in, and utilization, do factor into your total score. Those are your three primary scores, and what's most important is to pay your bills as agreed. Now, we're not done yet. We're not even close. We've got all these other scores to dive into just because you need to know how to control these, and there's some cool things here you might not know about. So the bottom line, guys, when building business credit, you get some accounts that report to the business reporting agencies. You pay them as agreed. You make sure that you don't give them your social so they don't report on your consumer credit report. They report here. When you have one with Experian, one with Equifax, or three with D&B, that's enough to score you. And then again, your scores will be based on how you pay. So if you pay your bills on time, you get good scores here, good scores here, good scores here. Then you go in to apply for Apple, let's say. Apple, you say, Mr. Apple, I'm going to leave my social off the application. I don't want you to pull my consumer report. I'm going to have you pull my business report. They do. They see those trade lines and good score. They give you 12.5 with no personal guarantee and no personal credit check. It's exactly how the process works. Should I get a secured business credit card at Wells Fargo? How good's your credit? You know, vendor accounts are a good way to build your business credit. Here's my advice. Anyone know what is the Small Business Financial Exchange? Yes, that's a place where a lot of the reporting agencies get their data from to actually create their scores. So there's a few different ways to build initial business credit. You can get places at Uline, Quill, example, or Quill, Gimpler's, Granger. You can get a secured card with Wells Fargo, but they'll pull your personal credit and it has to be good. You can also come in here and use another way, which is if you have a 680, 685 score or higher, or a guarantor that has this kind of score, you can also get up to $150,000 in unsecured financing, 0% rates, no doc, based on good personal credit. So you got two options. If your credit sucks, well, use vendor accounts to build your business credit, to get your established reporting agency or establish your business credit reports that way. If your credit's good, don't go with a secured credit card. Get an unsecured card. Get 5 unsecured cards, 50, 100, 150,000 in real usable money. You can also take cash out on these 100%. So if you got approved for 150, you could take the cash out for 150. And this is a much better way to go than that. So if you think this may fit you, well then, give us a call. We'll talk to you more about the unsecured program, 877-600-2487. That's better than Wells Fargo's secured card. Let me see here. So I've been told that the type of business determines whether or not banks' credits will offer lines of credit, true or false. Well, we can see that right here, that you can see how little it does tie in, but it does tie in. They will look at your industry to see if it's high risk, SIC. If your industry is high risk, then yes, you can absolutely get denied because you're a high-risk industry. Financial services, credit repair, insurance agents, real estate agents, mortgage brokers, pawn shops, anybody that deals with adult entertainment. These are all considered high-risk industries. So high-risk industries can get you denied for bank accounts, merchant accounts, and business loans, yes. Which is why you want to make sure that your business name doesn't reflect you're in a high-risk industry. Not much you can do if you're getting a loan. If you're getting a loan, they're going to research your business. But if you're getting a credit card, you can get an automated approval even if you're in a high-risk industry if Your business name doesn't indicate that you are. So for example, if you put something in your name that indicates you're in a high-risk industry, that can get you red flagged when you go to apply for revolving credit and force a manual review. If you have a name that even if you are in a high-risk industry, if you're in credit repair and your company's ABC Consulting, well then they're not going to pick up your in credit repair by your name. You can get automated high-limit revolving credit card approvals that way, but getting loans is a little bit more tricky. They're going to dive deeper, and in doing so, that they're actually going to get, they're going to know what industry you're in. So hopefully that answers your question. Q, I've been wondering that as well. Wells Fargo says they do report. Well, they report to the Small Business Financial Exchange. So the SBFE is basically a place that the credit reporting agencies get their data. So by Wells Fargo reporting to the Small Business Financial Exchange, the other reporting agencies pulled data out of there, and that's what they also use to populate onto their reports. That's why one of the reasons Wells Fargo can report. Is it true to get a business credit card you must always have a personal guarantee? Of course not. That's ridiculous. Think about it. Do you think Michael Dell guarantees theirs? Do you think the CEO of Pepsi and Coke is giving their social when they're getting credit for the business? It's insane. Of course not. But in order to get credit without giving your social, you have to have established credit. That's where people mess up, is that you can't walk into Staples with no business credit and get a business credit card without a personal guarantee. You can't walk into Staples with no consumer credit and get a credit card without, or period, you won't get approved. The bottom line is you have to have credit established. Guys, if you look at the definition of a personal guarantee is required when your business doesn't have enough credit to stand on its own. So if you need a personal guarantee, you don't have enough credit built. That's why you should follow us here on Facebook. We'll map out the steps to build your business credit. And as you get 2, 3, 4, 5, 10, 15 trade lines, then more and more credit becomes available without the personal guarantee. The key is nobody's going to give you credit without a personal guarantee just because you have an EIN. Your EIN has a credit report. Your EIN has credit scores. If your EIN has bad credit scores and no credit report, of course you're not going to get money without a personal guarantee. But if you build a credit profile under your EIN and you have multiple trade lines and good scores, then you leave your Social Security number off the application, get approved without the PG and without the personal credit check. That's how the process works. So when we look at the three most popular scores, D&B's PAYDEX, Equifax's credit risk score, Experian's Intellis score, it's all about how you pay your bills. But here's what else you got to know. There's other scores that these reporting agencies offer as well that you're not going to see a bunch of information located out there, or you're not going to see, you're going to see on your business credit reports along with this. So we're not used to this. In the consumer world, if I pull a TransUnion report, I have a score on it. In the business world, if you pull a D&B report, you could have a PAYDEX, you could have a delinquency predictor, a financial stress score, a SIR rating, and a DB. You could have 5 scores on one report. So what do these things mean? Well, the delinquency predictor predicts if you're going to go late in the future. So D&B really has 2 kinds of scores. They have predictive scores that predict what will happen in the future, and performance scores that are based on actual past payment performance. PAYDEX is a performance score. It's based on how you've actually performed in the past or paid your bills. The delinquency predictor predicts how you're going to pay your bills in the future. Okay, so if you're paying your bills good now, then D&B obviously is going to see that you're probably going to pay your bills well in the future, and your delinquency predictor is going to be high. Your financial stress score is a score that's used to see if you're going to file bankruptcy in the next 12 months. Experian has one too. It's called the Financial Stability Risk Score. Equifax has one as well. It's called a Business Failure Risk Score. They're used to depict if you're going to go or if you're going to default or go bankrupt in the next 12 months. Okay, your SIR rating is if you're a supplier, rated on, it's used to rate whether or not you're going to default as a supplier and stop delivering on your orders. And a D&B rating has to do with your financial information and your actual payment history. So I'm going to talk about the D&B rating because this is a factor you can control, and you need to know this information. So here's where people really go wrong with building business credit. A lot of people think that because they build their business credit, they're going to walk into a loan and get a loan easily because they have trade lines and a good score. Here's the problem. The problem is when you go into a bank to get a business loan, they're going to pull something called your D&B rating. Your DB rating takes into account 2 things. 1, your payment performance, how you paid your bills, same as PAYDEX. 2, your financial stability. Basically, what do your tax returns reflect? What are your revenues? What are your profits? Are you a brand new startup or are you an established business doing millions? This is what banks will look at, and this is why it's harder to get a bank loan than high limit revolving credit cards. So here's what you need to know. If you have good tax returns, make sure that you get them to D&B. D&B gives you a way where you can even submit your financial data to them. And if your tax returns are good, that combined with your actual payment history is going to give you a good D&B rating. It's also going to help